Hi guys, we are here for another session on the Samvada broadcast, and today we have Robin Joseph with us. Robin is an investment advisor. He's SEBI registered, and he's our go-to person and expert when we want to, ask about anything that's related to the market. So, hi Robin, thanks for joining us. And
Hi Antariksh, thanks for having me.
yeah, and there's so many of our readers and people who wanted to understand or have been asking that you should talk to somebody from who understands the share market and investments in general. So we thought that we'll
Mhm.
grab you and bring you to our broadcast. So welcome, and
Thank you.
I would immediately dive into asking you a bit about. We will take it from investment for every kind category of people. So we'll start with beginners, right? And
Okay.
for beginners, we usually talk about long-term investing, and
Mhm.
the key word these days is compounding. Everybody is saying, "Okay, you put this money, you
Mhm.
will get compounding and all that." So tell me a bit
Mhm.
about how a beginner should look in his investment or her investment journey as, and what is it that they can look forward to, and what is the whole compounding process all about?
Okay, for younger generations, I would say start early. That's the buzzword for them, start early. Okay, pure mathematics says that, let's say if you start with let's say 15,000 rupees, okay, now you are 25 years, okay, and you want to create a corpus of 10 crores by the age of 60. At age of 25, you need 15,000 SIP. Now, if you started at 30, you need around 30,000. Now, if you start at the age of 40, you need 1 lakh monthly SIP. So the buzzword for younger generation is start early. And what has happened in the market from post COVID, I would say, Antariksh, so many young investors who began post COVID have seen the booming market. They
Right.
have seen the Nifty going from 12,000 to 26,000. Now this is a phase where market is correcting. There is a lot of nervousness among the younger generation, especially why this is happening. Okay, so one thing is this markets, it does not go in a linear phase. It has its own zigzag movement. Has its own cyclical downturns and all. And for the younger generation, I have several clients who were investing, let's say if it's rupees 100, they were investing rupees 80 in mid cap and small cap. Okay.
Okay.
So first is start early. Second is the money that you're putting has to diversify into different assets. First should be equity, second is debt and gold.
Right.
For younger generation, my equity asset allocation would be 60 to 70%, 75% will be max, 10 to 20% will be debt. That could be debt funds or high yield bonds or corporate bonds. And the remaining 10 or 15% will be in gold and silver. Okay.
Okay.
And the allocation, especially in equity, I would say in small and mid cap should not be more than 30%
Mm-hmm.
at this current time when we are seeing a lot of market volatility.
Mm-hmm.
So that's my
So, so,
advice for younger generations.
so somebody who is absolutely new to this and doesn't really even understand how to look at a company from a mid cap, large cap, or even a small cap perspective, what would you say
Yeah.
is the market capitalization for a small, a medium, and a large organization? Like, how do you define that? And you obviously told us a bit about youngsters getting in and what their portfolio should look like. But
Mm.
what about a different bracket? What about young mothers or mothers in general who want to start at 40? Who want to try and take out some sort of income from the stock market, or at least start investing, right? And then I would also want you to touch on what a senior citizen who hasn't really invested in the stock market, if at all, or rather actively, invest in the stock market. What would a senior citizen's portfolio look like? So, if you can touch on all these things.
Okay, so I'll start with the senior citizens, the retiree. Okay, for retiree, I would not say not more than 40% allocation and equity. Okay. And also in that allocation, predominantly it should be in large cap stocks. And for the senior citizens, my advice will be do not dabble into stocks. I think there are equity mutual funds where you need to invest, okay? Because these are fund managers who have richer, much better equity experience than we are shortlisting stocks and all.
Mhm.
So rest your hard earned money in the hands of fund managers who will deploy it.
Mhm.
And for senior citizens, I would say not more than 30 to 40% in equity.
Mhm.
The remaining 10 or 20% you can dabble around with balanced hybrid funds. 30% to 40% should always be there in debt allocation. If it's above 60, I would say roundabout, if it's husband and wife, a major chunk should be in senior citizen savings schemes from where they get a regular income. And 10 to 15% for every category of age, I normally say 10 to 15% should be in gold and silver as commodities.
Right.
So this takes the how to take care of senior citizens. For category of 30 to 40, I would normally say 100 minus your age. Okay, if 40 is your age, 100 minus 40, 60% should be your equity allocation. Also in that, predominantly should be in large caps, 20 to 30% in I would say debt, and the remaining in gold. And while you're aging, you need to start decreasing your allocation of equity, maybe by 5% every 5-year term.
To sort of minimize the
And
risk.
for mothers, yeah,
Mm.
yeah. So I think for mothers and all who are entering into stock market, I would say please get into stock market through equity mutual funds. Start with a 10,000 SIP. Understand the nuances of equity fund investing, what are expense ratio, and also to the new joinees and all the ones who are joining new, I would say always invest in equity funds through direct route. Do not come through a mutual fund distributor. There are a lot of direct platforms like Zerodha, Paytm, Grow, which charges direct. These are direct plan funds. Enter through them.
Mhm.
It's a very good, easy user face interface. Even a retiree who is 70 years old or 25 years can easily go through and invest.
Mhm.
So that's how mothers, 40s, and retirees should start behaving, putting their money in stock market. But I would say stock market is complete no. First, build that equity research experience and then dabble in stocks.
Okay. Okay. And we were also going to discuss about what range do we see a mid cap and a small cap, because you obviously referred to having a portfolio with a mix of
Yeah.
mid, small, and large. So what is
Okay.
the market cap?
Okay. So okay, I'll just take one step behind, and I'll explain equity. How
Mhm.
you enter equities can be in three ways: either through equity mutual fund, where you rest your money in the hands of mutual fund companies, AMCs. Second is exchange traded funds, that is called ETFs, which you can buy through your demat account. It's like you can buy it and sell it anytime. And the third one is stocks. Stocks, I would recommend no. If you have equity research experience, only then dabble in stocks. For the entire janta, I would say equity funds and ETFs. While I'm talking about equity, there are two framework to it. One is every investor which I speak to as an advisor have to create a core portfolio
Okay.
and a satellite portfolio. So core portfolio has to be made from your exchange traded funds, your large cap mutual funds, large cap stocks and all. While your satellite portfolio could be mid cap or small cap companies, which gives you that fillip, which gives you that alpha returns. Now, coming to large cap and mid cap definition, large caps are normally, if I say large cap mutual fund, they are mutual fund which invest in the top 100 companies of India. Mid cap will be the next 250, and the entire universe after 250 could be 3,000 small companies with market cap maybe greater than 100 or 500 crores, fall under the small or the micro cap companies. So
Okay.
that's a brief framework of large cap, mid cap, and small cap.
Okay. You mentioned that people who are beginning, especially youngsters, I think they have the appetite to take more risk, right? And you said that they have to do more research and they have to try the equity market and get accustomed to it before they actually start putting in big money. Where does one start? Do I go to a classroom or do I go to probably an online course? Are there tools that I can use to get myself started? And how do I keep a track of in my investments? And how do I learn from that? Can you touch some tell us a bit about that?
Oh, for equity mutual fund or stocks, you're asking?
For stocks, I think I speak to a lot of youngsters and they want to make 10x in a year, right? So
Oh,
obviously they come with
yeah,
that mindset. So
yeah. So they have seen the greener pastures. They have not seen the ugly side of the market. I've been part of the market from 2006. I've seen the global financial crisis when the markets went down by
right,
50%, then COVID crisis and all.
right,
I would say for the youngsters, especially, I would say there are a lot of Telegram groups. First is stay away from them.
okay,
Okay.
okay,
And first is stay away from Telegram groups who say that put in 5,000 and we'll give you swing and positional trades and option trades and all where you can double or multiply the money.
mm,
To all youngsters, while I preach, I'll teach in colleges also. I
mm,
normally say no to drugs, and the second thing I say is say no to intraday trading because I've seen
okay,
families getting destroyed because of intraday trading. So
wow,
don't dabble into trading at all. This is my first and most important feedback to the younger generation. And now, second thing is how to learn about stocks and all. I would say for equity funds, I would say there are lovely magazines which come of value research, mutual fund insight, and every Monday, if you can buy a 8 rupees magazine of Economic Times ET Wealth, that
mhm,
would give you a good exposure about mutual funds.
okay,
Learning about stocks, I would say there are a lot of YouTube channels. I don't want to recommend a lot of YouTube channels and all,
okay,
but Zerodha Varsity is a very good forum where you can learn about stocks in general.
mhm, okay,
Okay, and more information about stock market is easily available in YouTube.
mhm,
But yeah, don't get. There are a lot of influencers which are advising wrong information,
okay,
and has SEBI is getting strict with them, and in few months' time, you will see a lot of changes happening in that arena. Also, a lot of influencers shutting down their shops and all,
mm,
because SEBI wants registered investment advisors who give independent and advised view.
okay,
So that's why we are here.
all
So
right,
that's my three
okay,
feedbacks. Stay
yeah,
away from intraday trading, learn more knowledge, general information. Zerodha Varsity is a wonderful forum where you can get every detailed information of stock market and derivative trading and all.
okay,
But yeah, stay away from derivative trading. That's also
got it,
important. Yeah.
yeah. So, a lot of our viewers and readers are also business owners. And
Hmm.
what sort of opportunities do business owners have, especially with the kind of surplus funds they have? Do they have an option to invest in the market or any other, financial tool where their surplus funds are not simply lying idle in the bank, but are it's growing. So, is there something out there for them?
I would say for business owners, okay, if I say HNI is a high net worth business owners, there are a lot of alternate AIFs, alternate investment funds and all, where the minimum capital investment is 1 crore. It's a high return, low risk. It does not depend on the market volatility. It
Mhm.
normally depends on the private equity investments, startup financing, hedge funds, and all. So that's more into detail while you read through it. That's for high net worth business owners. There is
Okay.
also private equity players where you can invest in a lot of startup firms and all. But I would say three basic easy money making money multiplier products are equity, where you can enter through stocks, ETFs, or equity mutual fund. Debt could be through debt funds, corporate bonds, high yield bonds.
Okay.
And the last part is commodities, gold, and silver.
Okay.
So I think the last three are the most important ones. And there are a lot of PMSs also, portfolio PMSs, but the strange thing is we have seen the mutual fund returns much better than the PMSs. Okay. So it's better that start with mutual fund as you gain knowledge, increase your mutual fund investments.
Okay, I want to try and dig deeper into the mutual fund space because that's something that a lot of people advise and people want to understand how does
Yeah.
one get involved. One is obviously the way you invest. There are people who talk about SIPs, and there's also lump sum investing. There are pros and cons to both, of course, but everybody comes from a different background. Somebody who's on a salary, has a recurring income, so they like to do an SIP, for example. But somebody who has a business or is in the gig economy is on some days they have the funds, but in some days they don't. So they like to. I don't know whether they want to do lumps. They should be doing lump sum investing. So give us a little parallel on lump sum investing, the SIPs, and what is the difference and
Okay.
pros and cons of both for people. Yeah.
Okay. So SIP is mainly your systematic investment plan where you put in X amount of money every month. Okay. Lump sum is where if you get some bonuses and all, where you put entire chunk of money in mutual funds. Okay. Lump sum, when the markets are at all-time high, which is the current scenarios, we advisor says do not put money in lump sum in mutual funds. And also, if you're putting that money, okay, so there's a general principle that I follow. So let's say Antarish has 5 lakhs money as lump sum, which he got from his father or from, let's say, variable or bonus income that he has got. So my question to Antarish would be, how much months did you take to get this 5 lakhs? Okay, he might say, Robin, I would take about 1 year's time to gather this entire 5 lakhs. So as a financial advisor, and the principle that we use is, if it took you 1 year to create this corpus of 5 lakhs, scatter this in half of the period, which would, I would say, 6 months. Okay. So the entire 5 lakhs, you scatter it in 6 months' time. Okay. And right now, to my clients and all, since market is at all-time high and we may see market bottoming around 22,000 or 21,500, the advice I'm giving to a lot of clients who have lump sum sitting with them in their bank accounts and cash and savings and all, whenever you see market going down by 1% or 300 points, like today it went down by 355 points, invest maybe a 5% of that chunk judiciously, so that you do averaging. Okay.
Right.
So lump sum is also a, yeah.
You're saying that you stagger your investment.
Yeah.
Because
you stagger it, and the best way I would say ETF, because ETFs is the best way because it's real time pricing. You sell and buy and sell at the rate real time, while there is some of bit of tracking error between the real NAV and the market price. But yeah, so if the market goes down by 1.5%, you will see the ETFs also going down by 1.25%, and it's a good play for retail investors, especially to invest in, especially two ETFs. I would say 2 or 3 ETFs. One is Nifty Bs, Bank Bs, IT Bs. These 3 ETFs, I tell my clients to invest instead of mutual funds. You can invest over here. And these are ETFs are more or less like mutual funds. Good thing about ETFs, very lower expense ratio, while mutual fund has a higher expense ratio of maybe 1.2%. ETFs have 0.07%. Okay, and there's no exit load like mutual fund companies charge. You don't have exit load over here, so it's easier to maintain and forms a core portfolio for young or mid or senior retirees, and it's a good forum for retirees also to invest.
Okay. there was also with SIP, there is a lot of chatter about SWP, right? And a lot of
Yeah.
people are talking about using that, especially for the elders and seniors who need some sort of
Mhm.
money. So can you throw a bit of light
Mhm.
on that? What is SWPs and how can elders use that?
Okay, so systematic withdrawal plan is a very effective mechanism for retirees to earn a regular income. So let's say if uh, um, if Mr. X has a 2 crore corpus lying in his equity fund or a debt fund, what he can do if his regular expenses monthly is around 60,000, okay, so he can put a request in the direct platform of MF Central or any the brokerage platform that I need to get 60,000 in my bank account every month.
Hmm.
Okay, while you get that money, there is a added benefit that the 2 crores maybe after 5 years, because it's working in a compounded way, that 2 crores will not reduce. It may become 4 crores maybe after 10 or 15 years, not 15 years, maybe after 6 or 7 years. So
Hmm.
that's the power of compounding. While you're withdrawing some amounts, you're not withdrawing the entire amount. The rest of the remaining amount keeps on compounding how the market behaves. So it's a very effective tool for retirees, SWP. But yeah, go ahead.
No, I was going to get to. You actually mentioned a couple of times that the market is at all-time high. It's an all-time high. Where is it going
Yeah.
from here? What is the bottom line according to you? And there are obviously a lot of talks about a lot of stocks that are volatile also at the moment. I think only the most popular at the moment is an Adani stock, which is going berserk in terms of
Yeah.
its lows and
Mhm.
highs. So
Mhm.
touching both topics, where are we when it comes to where the market stands? What do you think is the bottom line, and what is your take on the volatility of such stocks?
Okay. I think last 3 years has been really great for stock markets. People have earned really good. Mid cap and small cap funds have actually given 50% returns and all. So a lot of mutual funds have given good return. Now coming to stock market. Okay, stock market has its own cyclical downturns and upsides and all. Okay, so uh, what we have seen into the equity markets, the reason for this sell off, okay, there's always a reason for selling equities, and this the reason for sell off this time is FII is selling. The reason why FII is selling is because of a lot of factors of the Trump, the US bond yields increasing, so money is flowing into US, and also China stimulus. FIIs are pulling their money and putting into Chinese market, which are reasonably valued.
Mhm.
Okay, so that's the one of the reason why there is a sell-off in the markets. So I would say a good level could be 21,800. That will be a bottom zone for Nifty, or 22,000. That will be a bottom zone for Nifty.
Mhm.
But yeah, when it touches 21,800, it will surely go for a bounce. Okay, and
Mhm.
then it would start its journey. But my piece of advice to investors is, do not expect the kind of returns that you have seen for the last 3 years. Okay, don't expect where the Nifty grows by 20%, 23% last year, averaging 23% for last 3, 4 years. Don't expect that,
Mhm.
because see, the condition of the economy is also not great. There is a slowdown in urban market. GST collections are down. Auto sales are down. Your cement, paint, QSR restaurants, their business is also going down.
Mhm.
A lot of bank credit is slowing down.
Mhm.
So yeah, somewhere economy is also, the growth in mainly in the large cap companies are slowing down. Okay,
Right.
and they would have an effect in the stock market as well. Okay,
It's
so but
interesting.
yeah,
It's
that does not mean
interesting.
you stop your investment.
Right. It's interesting that you got the sectors into play. What sectors do you think are going to be good for investing now? Like looking at the future, what are the most promising ones that people should be looking at?
Okay. I will put my money in banking and financial services because this is a sector which has been consolidating for the last 2 3 years, and the returns are nowhere in, maybe in the negative or in the neck to neck zero situation over there. I would put my money in the banking sector. That's why I tell my clients also, if you have lump sum, please buy bank B's ETF also whenever you see a drop in Nifty. Okay, because the next round of I would say bounce back or reversal, you will start seeing when the banks and the financial services start performing, and also IT sector. While IT has been consolidating and they have given a breakout post elections, we might see things moving over there uh, because of Trump. You will see a lot of money flowing into US corporate sector. They will be rich, money rich over there, while they would then try to maybe put more money into their IT systems, where that money will flow into all the outsourcing companies like TCS, Infosys, especially the mid cap companies like Coforge, NIIT, Persistent are my good picks and all.
Okay.
Pharma is also a good sector where you can invest. So banking, definitely yes. IT and pharma, where I would say there is more scope for improvement, where these will be my sectoral picks. But in terms of large stocks that I would want that I want the readers to invest, easy ones: Reliance, HDFC Bank, Larsen and Toubro, HUL, ITC.
These are all large cap.
On buying because they are more or less in a consolidation phase, may give a breakout anytime.
Yeah, these are all large cap stocks. So these are the
Yeah, large
these
cap.
are
Yeah.
these are the safer ones.
These are the safer ones. Okay, but see, the the ones, those guys who have actually bought all the defense stocks, the PSU stocks and all.
Hmm.
Okay, so I'm not saying don't put your money over there. If
Hmm.
you see money it going to the demand zone and all, then only put money.
Okay.
While we have seen a lot of mutual funds which came with that sectoral theme of defense and PSU and PSU bank and all are
Hmm.
right now in negative zone. So
Hmm.
stay away from stocks, stay away from specific stocks which has given a good run in the last 1 or 2 years, I would say, because they're already in a peak. While they have retraced, you can buy some, but you do not have to put the entire lot in them.
Okay. My last question is going to be more about from an investment standpoint, and this is these two are all they're people who are always at loggerheads in terms of investment.
Mm-hmm.
The stock market or real estate. These are two areas that is
Mm-hmm.
a matter of discussion for everybody all the time. I know that you're a big
Mm-hmm.
advocate for the stock market, of course, but what is your
Uh-huh.
take in terms of when somebody's looking at their investment journey? Should they be looking at only the stock market, only real estate? Are we talking about a mix of both? If yes,
Mm-hmm.
how do you see somebody
Yeah.
creating that mix? Have
Mm-hmm.
you made that mix? Do you invest in real estate? What would be your take on that?
Okay. As a advisor, I normally tell my clients that real estate should not be more than 40% of your overall net worth. Okay, that's first principle. Second principle is the loan, real estate loan EMI should not be more than 40% of your overall net take home. Okay, so these are basic two principles that the salaried professional should follow. Okay, and now coming with the topic of real estate or stock market, I would always say real estate should always be more emotional. When you require it for your self use, only then buy it. Not in favor of investment, because I believe in mathematics. Okay, we have seen the last 20-year run in real estate versus stock market. The equity annualized gains have been 15% for the last 20 years, while real estate is around 9%. Now, in basic mathematical terms, let's say if you have invested rupees 1 in real estate 20 years back in real estate, that would be somewhere around 5 rupees. But if you had invested 1 rupees 20 years back in equity markets, that would be around 17x. So 17x versus 5x. So that's the answer. But real estate obviously should be there for self-use. Do not create it for investment purpose. And most important, real estate goes through a cycle of 7 to 10 years, Antariksh. So what we have seen, 2005 to 2020, or I would say 2012 to 2021, the CAGR of real estate was 5%. Now, in the last 2 years, it has skyrocketed by 100% in some areas of Noida and all, Gurgaon and all. But there would be a standpoint where it comes that the stagnation would start and the cycle would start. So that's my only advice to people who are investing in real estate. When you enter real estate cycle is a key driver for your long-term returns. Okay? So let's say if I buy a property in Noida, Yamuna Expressway at a peak, you can expect that the stagnation will be there. Okay,
Right.
so timing in real estate, I would say, is more difficult than explaining individuals the timing in stock market.
Fair enough. Fair enough. Thanks a lot, Robin, for your time. I think a lot of insight from your end. We'll tune in with you again to
Yeah, sure,
understand a
sure.
bit more about the market very soon. Thanks.
Yeah.
Thanks for joining us.
Thank you, Antesh. Thank you so much.
Bye.